Welcome to the Retirement Guy Podcast with Gary Alden from the Kingwood Investment Group. In this podcast, we educate people in or near retirement so they can make informed decisions and bridge the confidence gap. Learn how to mitigate risk in retirement so you don't run out of money before you run out of you. Join Gary Alden and explore strategies on how to live a stress-free retirement.
Hello and welcome to the Retirement Guy with Gary Alden from Kingwood Investment Group. Today we are covering Life Insurance 102, which indicates that our last podcast was Life Insurance 101. So if you have not heard that podcast, go back and check it out. Good morning, Gary. How are you?
Good morning, Eric. We are just fine.
Fantastic. I know that we're covering a second part of the life insurance topic, and there's so much to it. I know there's a ton. But before we get started, I'm sure you've got something to stump me with, some sort of trivia question that you're gonna boggle my mind with. What do we got today?
Well, let me see. How are we going to phrase this? Well, let's do it this way. What does the state of Alaska and a typewriter have in common?
What do they have in common? Unless it was invented there, which I highly doubt, because I think it was invented way before Alaska was a state. Yeah, I don't know, Gary. I'm going to have to wait till the end of the podcast, I suppose.
See, I didn't know this either until I found it, but I kind of felt dumb. I went out and asked one of my three assistants, Rachel, Jill, and Aurora, the same question I just asked you, and Aurora knew the answer.
Really? Well, good for her.
And I went, yeah, good for Aurora. So anyway, Alaska and a typewriter.
Okay. All right. I'll wait till the end of the podcast to find out. Where do we start on life insurance today?
Well, Eric, there's lots of different types of insurance. And, mostly, I would think most of us, when we purchase any type of insurance, we hope maybe we'll never have to use it. Like you buy car insurance. I hope I'm never in a wreck and have to use it. Or, my homeowner's insurance. I hope my house doesn't burn down. I hope I never have to use my insurance. But with life insurance, the question is not if you will need to use this protection, but when. And so we're going to cover today the different types of life insurance and cover some of the things such as the tax advantages that you can get with life insurance that you cannot get with other forms of investments, and the flexibility and the variety of investment choices. And again, I do want to emphasize, when you receive a life insurance settlement, the money from life insurance under federal law is income tax free. It always has been in the history of the country. But what's something that a lot of people aren't aware of, there's another type of tax besides income tax. It's called estate tax. So your life insurance proceeds might, keyword here is might, be subject to estate taxes depending on your particular situation and the amount of life insurance that's being paid out.
Oh, okay.
So kind of an overview here today. What we're trying to talk about is when you do buy life insurance, you need an objective. What are you trying to do? What are your financial obligations? What's your lifestyle? What's your age, income, assets? There's a variety of estate, considerations. Now, there are living benefits. There's death benefits. Obviously, if we pass away, life insurance is going to pay out. But there's also potential living benefits. Could create a cash reserve, and you get tax-deferred growth on that money. Could be that you're setting up a type of life insurance that can be used for retirement income. And there are a couple of special types of life insurance, when you properly structure them, can give you income in retirement that is tax-free. That's pretty sweet.
Yeah.
There's another thing called pension maximization. A lot of our listeners today, they will get a pension from a company. And when you retire from a company, you have a choice in that pension of, say, taking, let's just use an example. If I'm just taking it on my life only, say it's paying $3,000 a month, but jointly it's, say, paying $2,000 a month. And you say, well, why would I want two when I could get three? Well, what if I take $3,000 a month pension and I die the next week? My widow, my spouse, gets nothing. So if you take joint income, lower amount, $2,000 a month, as long as I'm alive, I get $2,000 a month. I pass away, then my wife gets $2,000 a month. So one of the things that's been around for decades and decades is a concept called pension maximization. So what you do there is you take the larger pension check, say $3,000 a month, but then you run the risk of, hey, if you die too soon or if you die before your spouse, you could leave her in financial jeopardy.
Mm-hmm.
So what you do with part of that extra $1,000 a month you're getting versus taking the joint payment is you go buy some life insurance. So let's say the life insurance cost me $200 a month, and that would give a lump sum to my wife to replace the pension. But the insurance only costs $200 a month, and I'm getting an extra $1,000. My net is an extra $800 a month.
Yeah.
So it's a real neat concept. But before you go out and do it, you need to make sure you're insurable.
Yeah, definitely.
So work with your financial professional to work out a strategy to see what would be best in your particular case. And then the other living benefit from life insurance is maybe to pay for expenses of long-term care or hospice care, because there are insurance policies designed to let you use part of the death benefit while you are alive to pay for long-term care expenses. Not all life insurance will let you do that. So again, several times per year, we take old life insurance policies that don't have that provision. And my son, Christopher, and I, we work with converting that over to a life insurance policy that gives you a long-term care benefit. So there's lots of things you can do there. So again, bottom line, life insurance is not necessarily for when you die. There's a lot of neat things you can do while you're alive.
Now, is that something that would be written into the contract, or is that a rider specifically that you would have to purchase in addition to the regular life insurance?
It depends on the insurance company, but most insurance companies, it's not a rider. It's just built in, but it's not a lot of the older policies. In fact, we're doing for a couple right now. This is insurance they probably took out, 20 or more years ago. It did not have that provision. A lot of the newer policies, it's just built in.
Got it.
It's just one of the provisions, and it's not a rider that you pay extra for. It's just there.
Got it. Okay.
So, I think most of our listeners are familiar with what life insurance does. If you pass away, it could help preserve your dependent standard of living, maybe help pay for college, maybe pay off the mortgage or any loans you have, maybe pay estate taxes, final settlement expenses, create an immediate estate for your survivors, maybe equalize inheritance for your beneficiaries, or maybe we just did this last year for one of our clients, and she is charitably inclined, never had any kids, and so we've got it all set up to donate to several of her favorite charities.
All right.
And then the last thing that a lot of businesses do with life insurance is it does do a nice equitable business transfer or to provide for key man insurance protection. So that's kind of general. So let's kind of dive down, Eric, now into the two general types of life insurance. One is term insurance, and the other is cash value life insurance, or some people call it permanent life insurance. So term insurance is just like what it says. It's done for a specific period of time, for a certain term, say 10-year, 20-year, 30-year. The problem with term insurance, if you take out 10-year term and you live 10 years in one day, you don't have any insurance. It's gone. The other problem with term insurance, most term insurance, not all, but most term insurance, it's like renting a house or renting an apartment. You build up no equity. You build up no cash value. So term insurance, even though it's lower monthly costs than, say, cash value life insurance, really in the long run, it's more expensive because you never get any of your money back. But there's a lot of reasons for term insurance. Maybe I used term insurance heavily years ago when we had several kids in college at the same time. I want to make sure if something happened to me, that there would be plenty of money to help the kids finish college. And in addition to that, here's a lump sum for my wife to replace my income. So lots of times it's used for that particular purpose for a college, or making sure it's an income replacement for your spouse for younger people. And then also some people, you just can't afford the higher premiums that a cash value life insurance offers. And the other thing is term insurance. Again, you can't accumulate any cash value. Also, there's not any money to borrow from, because permanent life insurance, normally if you have some cash value, you could take a loan from the insurance and then pay it back over time.
Yeah. And that's it, from my understanding. And I had term insurance as well. And I think it's a really good option for those that, like you said, can't afford something that's going to be maybe cash value. But when we planned it out, it was very specific to exactly what we needed or what we felt we would need. And I had insured myself with term insurance when my children were much younger, and I was in my 20s. My wife, was in her 20s as well. We had very young kids. And I just wanted to make sure that if something happened to me, we were in a unique position where if I passed away or she passed away, we would lose the place we were living. We would also lose our jobs because we both worked together in the same establishment. So we needed to replace all that. So I think we figured out about 1.2 million was what could be covered that would get her a house that they could live in without having a mortgage, and also an income on a monthly basis while the kids were young, so that she didn't have to worry about going out and getting a job right away. The transition, I would hope they would grieve for a little while at least if I were to pass away. But that was a good option for us. And as I got older, then I started to look into the next insurance I know you're talking about is cash value. Is that kind of what you experienced? Like you talked about it a little bit, but is term, do you think, the best option for younger couples with small kids?
Yeah, because usually if you've got young kids, you don't have a lot of money.
Exactly. Yep.
My father-in-law used to say, when you're young, you have two choices. You can either have kids or you can have stuff. So when you have kids, it's hard to have stuff, which means, there's not a lot of money left over at the end of the month after everything is paid for.
Yeah, exactly.
So again, just kind of wrapping up term insurance, Eric, there's three general types of term insurance. One, there's just level premium. It means you're going to pay the exact same premium payment over whatever the term is. Again, 10-year term, 20-year term, 30-year term. Then there's a thing called annual renewable. Now, this type of policy, it's kind of usually starts out cheaper, but every year on anniversary date, they're going to raise your premium. And then raise it and raise it and raise it. And you could get to a point, and I have seen this happen with clients, where you can't afford it anymore, but you start out kind of cheaper at the lower end, and then you pay more for it, going forward. And then there's a thing called decreasing term, and the death benefit decreases each year since less coverage may be needed as you get older. In a way, if you kind of look at your mortgage insurance you may have on a mortgage, that is decreasing term insurance, because every year your mortgage gets lower because you made payments during the year. So when you have mortgage insurance, they're literally insuring only the balance of your mortgage. So in effect, that is a type of decreasing term insurance. So the other type of insurance that we mentioned just a second ago, that's cash value insurance. And cash value insurance is probably appropriate if you want or need long-term life insurance and coverage. Now, again, most cash value life insurance, you're going to make payments on that the rest of your life, as long as you want to keep it. But they can't cancel it. Like term's only good for a certain amount of time. Permanent or cash value life insurance, as long as you keep making the payments, they've got to give you the insurance, no matter what your, say, health conditions are. And again, a lot of people want to build up a cash value. So you kind of like you build up equity in your home. You can build up equity in the insurance policy, and then say take loans out against it maybe in the future, and remember, if you take a loan out of life insurance, that's not taxable. Remember, if I go down to the bank and I take a loan, that's not taxable income. So, and you can do the same thing with life insurance. There's some really neat strategies. You can go out there, and some life insurance policies are constructed, even though you borrow money from your policy or from the insurance company, you don't have to pay back the loan. That's kind of nice. I kind of like that.
Wow, yeah.
I wish they would do that on my car.
Yeah.
Let me go down and have my new car, but I don't have to make payments to you. So you've got to really decide, is cash value life insurance right for you? Everybody's a little bit different. So that's when you sit down with your financial professional and determine, what's right for you or what's not right for you. Now, there's the most common type of cash value life insurance is something they call whole life. You're going to make payments for your whole life. It's a guaranteed payment. It's never going to go up. It's never going to go down. Now, your money's invested in a whole life policy, but you don't control the investment. The life insurance company does. However, they will offer you minimum guarantees. So let's just say the insurance company, for example, is promising you 4% per year, worst case. So you know your money's going to make 4% no matter what on the cash value of the policy. So it's a very, very simple policy. It's been around for, just like forever. The other type of life insurance we want to cover is called universal life. Universal life has flexible premiums. In other words, your monthly payment. Maybe you want to pay less, maybe you want to pay more, but it also normally has an adjustable death benefit. So you put your money in, your premiums every month, it goes into your cash value account, and you can make additional deposit payments in order to build your cash value. There is usually some type of a guaranteed interest, plus any additional interest on your cash value that is also redeposited over time. So again, we're not going to go into the details in each one of these. We're just kind of giving you, Eric, just a thumbnail. So that's universal life as a thumbnail sketch. Then there's a thing called variable life insurance. Now, this is designed for growth. This is a person, think of it more like your 401k plan. You've got investment choices within the insurance product, and you can invest in equity, in other words, stocks, or a stock like mutual fund, fixed income like bonds, or if you just want to have money in money market. So you decide where you want to have your money inside of a variable life product. And normally the insurance company will give you level premiums and a minimum death benefit. And your death benefit increases only if your cash value increases. So your cash value may fluctuate based on the performance of your investment elections. In other words, how much money you have in, say, mutual funds or stocks, fixed income, bonds, or money market. So it can go up or down. Then there's another variation on universal life, and that's called variable universal life. And as the name implies, this type of insurance provides the investment choices of variable life and flexible premiums of universal life. So they kind of combine the two. And this type of policy, Eric, lets you determine how much of your premium will be allocated to life insurance cost and how much is being allocated to cash values. And again, you can make additional payments credited to your cash value account. Now, the cash value and the death benefit in a variable universal life policy are not guaranteed. So there's more risk here. Now, there's pluses. You can't say any of these policies are good. You can't say any of these policies are bad. Eric, it's what fits your situation and what is good for you and your family.
Exactly.
Which could be totally different from, your neighbors down the street.
Yeah, absolutely.
Or me or anybody else. Then there's a neat thing, and it's called survivorship life, or sometimes it's called second to die. They normally call it survivorship life because they don't like to use the word die. So this normally, two people are insured on the same policy, but it doesn't pay off until the second person passes away. And your premiums are often less expensive than buying separate policies on, say, a husband and wife, because the insurance company doesn't have to pay off till both people have passed away.
Right.
And the number one reason that most people do these is to pay your estate taxes. And this is a way of paying your estate taxes with one, you're not going to pay any income tax, but it's normally used to pay estate taxes. So it's not beneficial while you're alive to either say husband or wife, because again, it doesn't pay off till the second person passes away. But if you have a large estate this is why people do these. And normally you're going to take this type of policy and you're going to put it into a type of trust called an ILET trust or an irrevocable life insurance trust. So when you buy the policy inside the trust is how normally most people are going to do it. You work with an attorney and your life insurance professional, and you put it inside the life insurance trust. So when the money comes out, it comes out both income tax free and estate tax free. And again, it's used to pay money for large estates. So this is something I know, Eric, you just do this job for fun. I remember, I think, reading you won one of those $300 or $400 million lotteries there in your home state several years ago. And you just do this to have something to do, talking to me.
It passes the time, Gary.
Passes the time. So this is normally used for somebody with a very large estate tax problem. It'd be a nice problem to have. Personally, right now, I don't have this problem.
Yeah.
And most people don't have this problem, but some of our listeners, you may have the problem today, or you may have the problem down the road. So it's something you need to be aware of that's available. And again, it's called survivorship life, or some people call a second to die policy. And it's going to be a life insurance instrument that you fund inside irrevocable life insurance trust. And that, again, that's when you get down with both your insurance professional and also an attorney, because it's one thing to buy the life insurance, but then the second part of it, you've got to have an attorney to create the trust to be able to put the life insurance into the trust document, if you will.
And we've spoken a little bit about this before, so just correct me if I'm wrong, but when you're talking about that, then the trust becomes the beneficiary, right? If I'm not mistaken, so that if you have children, they're not the beneficiary, so they don't have to worry about the estate tax or income tax or any of that stuff, right? Is that correct?
There you go.
Okay. And so that it gets paid out of there, so it's all, well, I don't want to say all tax-free, but like you said, it's not subject to those two types of taxes. And so your children don't get burdened with having to deal with your estate taxes and your, cleaning up anything else that you have outstanding or whatever. This takes care of it instead.
Yep, it sure does.
Okay.
And again, my job, Eric, I think our listeners know, Kingwood Investment Group, and we primarily work with retired people or people getting close to retirement. And I get a lot of job satisfaction out of helping people plan. But there's also the flip side of that. We're also there when somebody does pass away.
Yeah.
And this week, one of our longtime clients is coming in because her husband untimely passed away literally just a couple of years into retirement. And totally unexpected, didn't have anything wrong with him, nothing, it's kind of the normal. It was sudden. It wasn't like he had some disease and he was on a downward spiral or something. But and please understand the way I'm phrasing this, because we did do some life insurance planning several years ago for this couple. And you hope it happens when somebody's 95 or 100, but sometimes it happens when somebody's early in retirement, say early in their 60s. But it really is, it does give you a good feeling as a financial professional to be able to sit down, in this case, with a widow. And even though we're talking about the loss of her longtime, companion in life, her husband, her best friend in life, but to also be able to hand her a check for several $100,000 and to give her the peace of mind that her financial future is covered and she doesn't have to worry about money. It's one thing to lose your loved one without also having the additional, say financial burdens, like you're not sure, hey, do I have enough money to pay the normal bills every month? So when I meet with this client this week, one of the things we're going to be doing is filling out all the paperwork for her to get a large insurance settlement. And the insurance company normally will send that check to me, and then I will deliver that to the client. And it really gives you a nice feeling as a financial professional that you've helped somebody by planning you did years ago, when you hand that check to somebody and you know what that check is going to be able to do for them financially the rest of their life.
Yeah.
So anyway, I just want to kind of wrap up and just, talk about that. I really believe that life insurance should be a cornerstone of most people's financial life, because without it, Eric, your family may not have the necessary resources to meet their financial needs. And it's difficult enough to cope with the loss of a loved one, your spouse, without the additional financial burden of wondering, hey, do I have enough money to continue on in retirement? So selecting the type of life insurance, the amount of life insurance, how it's going to be properly structured to meet all your current and future needs, it can be difficult. That's why you want to sit down with a real good financial professional and to help you make informed decisions. And so you can be educated and make sure you get the right coverage that fits in your particular financial plan.
Yeah, absolutely. Gary, I know that you have a fantastic team that you work with. And I also know that you highly respect your client's team, if they have a team in place, if they've got an advisor or an attorney that they currently use, if they've got a CPA that they currently use, you're very respectful of that, and you pull the entire team together for the benefit of your client. How can they reach out to you and get a hold of you if they have questions? Because this was very complicated as far as all the different options. And like you said, it is very individualized. You have your own very specific individual needs, and everything needs to be taken into account before you start this process. So how do they reach out to you so you can get that ball rolling?
Well, there's two ways to do it. You can go to our website, which is www, as David Letterman used to say, thekig.com. And we have a place in there where you can ask questions or schedule an appointment. Or you can just give us a call, 281-359-7900 here in Kingwood, 281-359-7900. Talk to Rachel, Jill, Aurora, and they'll get you on our schedule so we can sit down and talk and look and see if there's any ideas or suggestions we might be able to give you. And again, all of our meetings are all complimentary. We don't charge you a fee. And again, just kind of remind everybody, it's not just me. We also have two tax professionals in the office, which can do your taxes. Well, they're both CPAs. And then also one of our CPAs, he's an overachiever, Tim West. He's also an attorney, so he can do your wills and stuff like that.
Wow.
And then we also have our specialist in dental plans and long-term care and Medicare planning. So really, it's a family office. We're one-stop shopping. We can do your investments. We can do your legal work. We can do your taxes. We can help you with Medicare and navigating through that complicated subject, or final expense or dental plans, you name it. If it kind of has to do in retirement, we probably do it.
Yep. You just don't do windows, right?
We don't do windows, and we don't do car insurance.
All right. So I only have one question left for you, Gary, for today. Alaska and a typewriter.
Alaska and a typewriter. That's really easy. There are, my last count, there are 50 states. Mm-hmm. The only state that you can type on your typewriter, type out the name of the state, is Alaska on a single row.
The middle row. That is correct. Huh.
So the single row, which I think isn't that the home row?
Yes,
row
the home
when
keys.
You type. I think that's what they call it when I took typing a couple of months back in high school.
Yep.
So you can type Alaska. It's the only state you can type on a single row.
Oh, there you go. All right.
So I know, Eric, you drink a lot. In fact, your wife's telling me you have a drinking problem. So the next time you're in a bar and, there's a question that comes up and you win a bunch of money by knowing the answer to that question, maybe send me a 10, 15%, finder's fee.
Sure. I'll get right on that. Absolutely. Okay. All right. Thank you, Gary, for your time today. I appreciate it.
Yes, sir.
All right. And thank you all for listening to the Retirement Guy podcast with Gary Alden. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when Gary comes out with a new podcast, it'll show up directly on your listening device. This makes it much easier to share these podcasts with your friends and family. Thanks again for listening today. For everyone at Kingwood Investment Group, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to the Retirement Guy podcast. Click the subscription button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Kingwood Investment Group. The content has been made available for information and education purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions that you may have regarding your investment planning. Kingwood Investment Group is independent of Next Financial Group, Inc. Securities and investment advisory services offered through Next Financial Group, Inc., member FINRA/SIPC.